Hello and welcome to EBAday 2022. I'm Debbie Bell-Hosking. And joining me in the EBAday studio is Manuel Klein of Deutsche Bank. We're chatting about stablecoin. Manuel, hello.
Hi, Debbie.
It's great to have you with us.
Thank you for having me here.
Stablecoin, a hot topic, I believe, this year.
Yeah.
So let's start by, if I may ask you to please describe the different types of stablecoins in the market and also how do they differentiate from each other?
Yeah, I think it's quite important to understand, especially in the light of this Terra collapse that we've seen a couple of days ago, to shed light on the different variations and the different types. So in general, I would say we have central stablecoins and decentralized stablecoins. So let's maybe start with these centralized stablecoins. Those are issued by institutions that are starting to get regulated. And basically what they do, they issue a token that is backed by high quality liquid assets, by bank deposits, and therefore, have this peg to the fiat currency. So most of all the US dollar, right? And then on the other hand, we have these decentralized stablecoins. And there are also different types. So first of all, starting with a crypto-backed decentralized stablecoins. DAI is an example. They're over-collateralized. They basically hold cryptocurrencies as an asset, most of all Ether or other stablecoins. They're over-collateralized and they basically work like a bank. You send cryptocurrencies into a smart contract and then the token is issued. So these tokens then remain stable to a US dollar as well. And then there's a big topic now, given the Terra collapse, there's this algorithmic stablecoin ecosystem. And there are basically two different versions, a rebase stablecoin where when the price depegs from the US dollar, additional tokens are issued automatically, or tokens are automatically burnt. And then there's, it's called seigniorage share stablecoin, where basically there's at least two tokens that correspond to each other, and given demand and supply pressures, additional tokens are issued or burnt, and that is exactly where this Terra stablecoin falls into, right? So they're not really backed by a token. They're algorithmically adjusted to remain the peg to the US dollar. And every time you create a stablecoin, this other token, which was the Luna token, was burnt. Yeah? And if you burn these stablecoins, then additional Luna tokens were created. So it sounds a bit complicated and a bit magical, but I think especially these algorithmic stablecoins have now also been debated quite strongly whether that is really something that we want to have.
Now you mentioned the Terra stablecoin. What did happen to the UST?
Yeah, it's been a very incredible time over the last weeks, and basically also mainstream media now writes about it. So I think what is really important to understand that it is not really a centralized stablecoin that is backed by other financial assets, right? It's this algorithmic stablecoin. And what happened was basically that the depeg happened, so the peg lost its peg actually to the US dollar, given in times of low liquidity, right? And then it was trading for, let's say, 97 cents, I think it was. And then the holders of the stablecoin panicked and actually sold more stablecoins. And the dynamic works as follows, as already described. In that sell pressure of that stablecoin, additional, they called it Luna tokens, are created. And it works as follows: as if you have one stablecoin that is worth $1, you would get always the equivalent of that $1 in Luna token. Now the price of Luna also collapsed. So if the price of the other second token collapses, but you would have to create additional Luna tokens, so additional of these tokens, in the same value of the stablecoin that is sold, then you have two forces that go basically into the same direction. So the price falls and the amount of, or the supply of Luna token is increased. And that was basically this death spiral, this hyperinflational death spiral that happened, because then you get into a situation in which the amount increases exponentially and the price collapses, right? And that is obviously something that is not good for the ecosystem, and everybody then lost faith in that project. and then they sold more stablecoins, and then the sell pressure was higher, obviously, than the demand pressure, and the stablecoin then depegged completely. And the result was basically that a stablecoin that had a market capitalization of roughly 18 billion US dollar has now only a market capitalization of 0.2 billion, so 200 million US dollars. And that Luna token, that other token that was created with such an exponentially force, it basically exploded. Like in 4 days, the supply exploded of 1.9 million% only in 4 days, right? So overall, the story is as follows: the stablecoin collapsed, the other token that was supposed to stabilize this whole thing exploded. Now the ecosystem is basically dead.
And how do you feel that's affected people's confidence in this algorithmic model?
It's been debated quite strongly now whether we really should include something like this in our financial markets and in that ecosystem as well. I mean, the market capitalization was 18 billion. It's quite large. It's not, it's not comparable to Tether or USDC, which are these centralized stablecoins, right? They're roughly ranging in the 70 billions, right? But still, it's quite large, actually. And now even Terra started a new ecosystem, right? So it's Terra 2.0 now. And obviously, now you have to come to question whether you should actually trust the same guys that run the project and invest again. And yeah, it's quite interesting. They want to have a market cap of 1 billion. They want to do airdrops to all of the holders that now lost quite a lot of money, actually, right? And there's no stablecoin anymore in that ecosystem. I'm not sure if they will succeed. I don't think so. And I think, yeah, algorithmic stablecoins have now come under scrutiny, and we'll see if other projects now will be launched again.
Interesting. So space to watch to see what develops there.
Correct, yeah.
And what about Deutsche Bank? Do you think they'll be providing a stablecoin?
That's an interesting question. I mean, when we look at our current money system, banks like Deutsche Bank provide money. So they're really important players in the monetary system. The vast majority of the money supply is actually commercial bank money. And now obviously the question arises whether this money supply, that is like 85% of the money supply is commercial bank money, can also be transferred via a blockchain. And I think there is a lot of room for that, right? Because how we see the regulation of stablecoins in Europe, for example, under the markets and crypto assets regulation, it's basically regulated as e-money, right? So electronic money. And the issuers also have to be e-money institutions. And what does that mean? It means that the tokens have to be backed by high-quality liquid assets, such as short-term government bonds. Now, the asset side of a commercial bank looks quite different. It's not only high-quality liquid assets, even though the vast majority of the money that we use is this commercial bank money. So the regulation that we see for stablecoins will probably not be applicable to something like a commercial bank money token. However, I do believe that this is something that we will see in the future, so that commercial banks actually tokenize their deposits. But that would be a little bit different than these stablecoins that we currently see, because if we use this technique to basically trade a token that represents a liability of a bank, then you would always have a claim against that particular bank. And if now all the banks issue their own token, you would have a Deutsche Bank coin, a JP Morgan coin, and they're not going to be interoperable. So what is still missing is the settlement asset, which basically we also have today in our current monetary system, where we settle transactions in central bank money. So what is a bit missing here is the settlement asset could be a wholesale CBDC, for example. We're going to, I think, talk about that later. So I'm not envisioning a future where we have multiple different, Deutsche Bank coin, JP Morgan coin, and so forth. They need to be interoperable, right? However, for internal use cases, so for example, for branch-to-branch settlements, I think there's room for something like a tokenized liability of a Deutsche Bank, right? And potentially also for providing that to our clients. However, every time when a payment is done to another bank, you would need something like a settlement asset. And I think now this whole discussion has just started, actually. And I'm quite curious what the future will bring, and I'm happy to work also on these solutions.
And I can see you're excited by it. Just to coin excuse the pun, to coin a phrase you just said, so similar but different perhaps.
Yeah, exactly. Yeah.
And then you touched on the central banks. So what role do they play in this picture?
Yeah, also a very good question. I think given that we have in our current money system, we have to look back. What is the part of the central bank that the central bank actually plays? And in the Eurozone, roughly like 10% of the money supply that we use as end customers is central bank money. It's physical money, right? It's physical cash. And now the question basically comes in, if we talk about retail CBDCs, so basically a digital euro, for example, for the end user, the question comes up is, should the ECB or should central banks actually provide a liability in a digital format to end users? Yeah? So what we currently have from the central bank is central bank reserves. This is the settlement asset for commercial banks, and physical cash for end customers. And now the question basically arises, should the ECB issue central bank reserves to everybody? So it's basically the question, central bank reserves for all or not, right? And once you answer that question, then obviously the question arises, which type of technology would you use? And this depends on the use cases that the digital euro from the ECB, for example, should be used for, right? So, but ECB is just an example. Basically, all the central banks around the world now look into this. And what we believe is, yes, there is a room for such a digital version of the euro from the central bank, yeah? But we believe that for all the innovative payments, I think the private sector is better suited, right? So now the question obviously arises, will the digital euro be used for all these blockchain payments, for all these blockchain payments use cases that we see? And I'm not so sure as of now, right? So when we look at the use cases that the ECB, for example, focuses on, this is point of sale payments, e-commerce, peer-to-peer, but also government payments, you don't necessarily need a blockchain for that. In future, maybe for other use cases, yes. But what we believe is that the private sector can actually play that role and basically provide the infrastructure to bring out or to deliver the digital euro on different technologies. So for example, blockchain or also account-based systems. So there's still a need, I think, for cooperation between the public and the private sector. That's the retail CBDC side. And then the wholesale CBDC side, to me, is very exciting, actually. And I think there's plenty of efficiencies that could be realized and materialized by introducing something like a wholesale central bank digital currency. So what's the difference? It's basically providing a digital euro based on blockchain technology only for banks. So for interbank payments or capital market payments. Yeah? And I think there you have plenty of advantages. So risk reduction, because you would settle in central bank money and risk less and save money, not in commercial bank money. You could reduce the liquidity buffers that are held in all the different nostros that banks hold. And you can do more efficient payments with programmability of smart contracts and have 24/7 capabilities. So I think in the wholesale area, especially, capital markets are looking at central banks and say, well, it is really a good idea. Or make financial market infrastructures be able to issue a token that is backed by central bank money. That would also suffice for the first time, I think. And then on the retail CBDC side, so a digital euro for the end customer, I think there is room for such a type of money, right? But I think what is quite important that the public and the private sector work together and make sure that what the ECB will come up with actually is successful, but not too successful, because we don't really want to disintermediate the commercial banks and do basically every payments in this new digital form of central bank liability.
And you were talking about collaboration there as well between the different sectors. So do you see the central banks releasing a stablecoin?
I wouldn't.
Or providing a stablecoin?
Yeah. So it's a good point. And first of all, I wouldn't consider a central bank digital currency rather to be a stable coin, or I wouldn't put that in the same bucket, because basically a stable coin to me is backed by money, whereas a central bank digital currency would actually be money, right? So there's no need to back the if it issues it in a token form, there's no need to back it by other money. But in general, I do see that there's a future for central bank digital currencies. On wholesale, definitely. On retail, I also believe that. And we see that in this research that is being done and all the POCs and explorations that are being done by now over 90% of all the central banks in the world. They do look into this, and I do expect that we will see such type of money in the future. And actually, from a monetary theory perspective, if cash declines, if the usage of cash further declines, then the anchor of our monetary system, which is public money, right? It's money from the central bank, actually disappears. So what we have on our bank account is actually a claim against the bank to withdraw money. So to withdraw physical cash. If physical cash doesn't exist anymore, then what is this claim actually on, right? So I think that is the perspective of central banks now, that if cash declines further and further, and we do see that development, then there is need for another type of public money, and that would be then this digital form of a central bank money.
Manuel, thank you. It's such an interesting topic. And as I said to you before, I can see how excited you are about it, and it's constantly changing. So thank you so much for your insight.
Yeah, thank you for having me. Pleasure.